Amrita's Son of Energy Aspects actually pointed to that phenomenon as a reason why oil prices are so low, not so high. And she actually thinks that Brent could get up to 150. I think you agree with her that by June we could see Brent get up to 150, but then quickly fall back down. Do you still believe that it will quickly fall back down based on the fact that a lot of people expect a prolonged conflict and prolonged consequences in the commodity markets?
Well, our scenario since October of last year was a spike to $120 a barrel by the summer. And we had that view based on a post-COVID demand recovery, on limits to how much OPEC can produce, on limits to how much shale is likely to respond, and of course inventories, which are still very low. I think what the Ukraine crisis has done is probably lifted the entire expectation by at least $25 to $30 a barrel. So we actually do have a $150 target for the summer in our baseline scenario, and an average of 110 for the year. It could still get worse, right? I mean, I don't want to sugarcoat this. It's a very bad situation, and Europe could still opt to restrict Russian oil purchases, in which case we would see meaningfully higher prices. That's what we call our ugly scenario, is where Russian supplies not only get disrupted by 1 million or 1.5 million barrels a day, but up to 4 million barrels a day in a market, of course, of 100 million barrels, where Russia actually supplies about 8 to the global to that global market. So things are not great and could still get a lot worse. And actually, if you look at the petroleum product markets, we've seen diesel prices already surpassing the high points that we saw back in 2008. So it's not just crude oil itself; it's also some of the petroleum products. And again, diesel is the basis of the economy, is the basis of everything we do, from harvesting to industry. And diesel is connected to jet fuel, which is obviously flying, but also trucking. So really, the backbone of the economy is being very impacted by these exceptionally high fuel prices. It's the new fangs, is fuel, agriculture, aerospace. It's also nuclear and renewables, and of course gold and critical metals. So it's all of that that's kind of come back into the fore with the crisis. So.
Francisco, you mentioned there an ugly scenario. In the ugly scenario, what does that equate to in terms of a dollar figure on a barrel of crude? How is that different from your base case of 150 by summer?
Our ugly scenario is $200 a barrel plus, and the way we get there again is pretty simple, right? I mean, if you think about every million barrels a day of disruptions from Russia equates to $20 to $25 a barrel on the price. So if we get to go from 1 million plus to 4 million or so, we have to add $60 to $70 a barrel to our baseline spike scenario. And as I said, I mean, I think that's been what's been so difficult to impose restrictions on Russian exports, because at the end of the day, when you sanction a commodity of a very large producer, you're ultimately going to end up paying a higher price as a large importer. And of course, the European Union is one of the world's largest importers, together with China. Mm-hmm. So restricting the supplies of energy from your largest supplier, which again Russia supplies a third of Europe's oil and 40% of Europe's gas, essentially would just significantly elevate energy prices, which are already at record levels. So that's why I think there's been a lot of political debate there.